Hello and welcome to the India Ratings and Research Outlook FY 2018. This series will showcase views from our sectoral analysts on a variety of topics on the state of the Indian economy. Let's start with the macroeconomic perspective as India spends another year in search of growth. Sunil joins in to share his forecasts on the macro numbers and what is in store for FY18.
Backed by consumption demand and government spending, we expect India's GDP to grow at 7.4% in fiscal year 18. While private final consumption expenditure is expected to grow at 8.9% in fiscal year 18, the government final consumption expenditure is expected to clock 9% growth in fiscal year 18. We are assuming a normal monsoon for the 2017, and on this assumption, we are expecting that agriculture would grow at 3%. Similarly, the industry is expected to grow at 6.1% and that of services 9.1%. Although GDP growth after bottoming out in fiscal year 13 has recovered, sustaining it in the medium to long term is becoming a challenge for the Indian economy, particularly due to non-revival of investment demand in the economy. In fact, backed by a good monsoon and 7th pay commission payout, it was expected that the overall GDP growth for fiscal year 17 will be very close to 8%. Our own estimate was 7.9%. However, the demonetization has adversely impacted the overall economic activity in fiscal year 17. As a result of that, now we are expecting that fiscal year 17 growth would be down to 6.8%, although CSO is putting it at 7.1%. In fact, one of the major challenges that the Indian economy is facing at this point of time is non-revival of investment cycle despite various attempts or efforts made by the government. The way we look at the whole issue of non-revival of investment cycle is that the two major sectors which could have driven the investment or which could have revived the investment cycle are manufacturing sector and the infrastructure sector. The problem with the manufacturing sector is that manufacturing sector is still saddled with excess capacity. The capacity utilization in the manufacturing sector is stagnating around 70 to 75%. And also the manufacturing sector is not very sure whether the demand would pick up in the near term or not. As a result, they are not very keen to undertake fresh investment. On the other hand, if you look at the infrastructure sector, then in this sector there is a huge deficit and we badly need investment in this sector. However, most of the infrastructure companies which are kind of investing in this sector are saddled with bad debt. In fact, the infrastructure boom that took place in this country around fiscal year 11 onwards led to a situation where infrastructure companies invested heavily without commensurate return because most of their projects got saddled because of policy paralysis. And as a result, what happened was that not only their balance sheet is under pressure, but because most of their debt was financed by the public sector banks, the public sector banks are also facing a huge amount of non-performing assets. So this twin problem of manufacturing sector not keen to invest and infrastructure sector wanted to invest but unable to invest because of huge debt in their balance sheet is leading to a situation where none of them are forthcoming for investment. Government on its own hand is trying to do its bit, and we have seen that in the last several of the budgets, governments have allocated huge amount of resources for infrastructure sector or for capex, but our view is that government investment alone will not be able to revive investment cycle in the economy. For that, private corporate sector investment has to kick in, and which is what is not happening at this point of time.
That was the macro view. Let's focus now on the outlook for specific sectors, beginning with banking and financial services. Abhishek explains the diverging positions for public and private banks and analyzes the problem with their asset quality.
As always, we divide our outlook on banks in three segments. We have maintained our stable outlook on private sector banks as well as the large public sector banks. However, we retain our negative outlook on the mid-sized PSBs. Just to elaborate, large private sector banks remain comfortable with adequate capitalization and improving liability franchise, despite some uptake in non-performing assets. Talking about public sector banks, we increasingly believe that while few of the large PSBs will continue to get some growth capital from the government and can aspire to grow their books along with the potential macro uptake, most of the smaller PSBs will still need to consolidate their book, focus on preserving capital through balance sheet optimization, and of course would receive maybe only bailout capital if needed from the government. On this aspect, let me give a perspective on the anatomy of corporate stress so far. Looking back at the progression of stressed assets from say 2002 onwards, this time the problem is largely balance sheet driven. Unlike the commodity cycle led cash flow meltdown in 2002, which again led to a rapid improvement by 2007, this time the median leverage levels are so high that even 2-3 years of sharp improvement in cash flows won't meaningfully alleviate the problem. Coming to numbers, overall we see about 21% of entire bank credit in form of loans to corporate and SME sectors in deep stress. Of this, about half has been recognized so far as either NPA or restructured assets. Now, looking at the 10% portion which is still not yet provided for, we see a larger mix of infrastructure loans. These are either loans to power projects, roads, EPC contractors, real estate and telecom. Many of these sectors either have viable assets in the longer term or they currently enjoy parental or a group support, and hence these are the assets which could potentially benefit from various handholding schemes by RBI like say an SDR or S4A or the 525 scheme. Another silver lining is that some deeply troubled sectors like say iron and steel today have seen some amount of recognition and provisioning as well. The bad news however is that now the current NPA stock for banks is huge at about say 10 odd percent, and about 80 odd percent of that is in doubtful categories, which would keep shifting buckets and attracting higher and higher provisioning as they age. These would consequently keep credit costs very high for public sector banks, and it would keep their earnings under pressure for at least next 2 years.
That was the banking sector view. Time now to shift our attention to the non-banking financial companies. Prakash presents his outlook on this space in addition to outlining our expectations for performance from various asset classes and the capitalization scenario for NBFCs.
We remain largely stable on the NBFC sector for FY18. That NBFC sector has become considerably stronger than they were about a decade and a half ago. Their systems and processes are far more robust, and they have developed stronger risk management capabilities, larger franchise, and far larger equity. Incrementally, they would continue to gain credit market share, especially from mid-sized PSU banks, which would continue to shed market share owing to combination of a large capital constraint, B, flight to safety in light of their precarious asset profile, and C, limited ability to price risk. In FY16, NBFCs, while having 17% credit market share, contributed to about 1/4 of total systemic credit expansion, a trend which is likely to continue. Having said that, there are certain areas of concern in few pockets that are building up, with few players that one need to watch out for, especially on the liquidity side as the stress tolerance buffers have diminished. Capitalization is adequate for NBFCs, and they also remain well placed to raise equity for growth. Some of the NBFCs operating in wholesale space and consequently having concentrated portfolio have stronger capital and liquidity buffers to cushion for stress. The leverage for retail NBFCs for most of the players remain reasonable even after factoring in unprovided non-performing assets.
From financials, let's shift gears to understand the road ahead for the auto and auto ancillary sector, a good proxy for India's consumption story. Sudarshan joins in to reveal the reasons behind a stable outlook for car makers despite a decline in the medium and heavy commercial vehicle segment. He also analyzes the impact of demonetization and GST on this space.
The overall business and financial profiles of auto companies are likely to remain stable in FY18. The industry is likely to witness an overall moderate volume growth driven by the passenger vehicle segment, which could grow at 6 to 9% year on year in volume terms in FY18. The growth in the passenger vehicle segment in turn would be driven by utility vehicles, which we believe will continue to display strong growth of 15 to 20%. In the commercial vehicle segment, we see a slowdown and largely attributed to MHCVs, which we expect will show a volume decline of 9 to 12%, while LCVs will continue to grow at 6 to 9%. The overall growth for the commercial vehicle segment would therefore largely be flat, varying from -2% to 2%. Coming to the key reasons for MHCV volume decline that we expect in FY18, we believe that we are on the verge of an MHCV down cycle as industrial activity has not kept pace with capacity additions in the road transportation industry in the past 3 years. We believe that replacement demand, which is the key driver of demand in FY15 and 16, has now largely been depleted. The key driver of MHCV sales in FY16 was high tonnage vehicles more than 25 ton capacity, but in FY17 volumes in this segment have shrunk substantially. In addition, we are seeing some preemptive purchases of MHCVs in Q4 FY17 to avail of lower prices before BS4 emission norms kick in from FY18 onwards, leading to a spike in new vehicle costs as well as a small increase in operating costs. GST implementation in FY18 will also release significant capacity into the system given the shorter transportation times, as trucks will now move more efficiently from one state to another, with octroi posts and check posts being closed down. The light commercial vehicle segment, in our opinion, has continued to demonstrate moderate growth due to factors such as exponential growth in online retail sector and steady demand for last mile transportation, demand for movement of essential commodities such as agri commodities, milk, etc., as well as use as rural taxis. In the two-wheeler segment, the agency expects domestic scooter volume growth to remain close to FY17 level at around 15% to 18% and lower than previous years due to base effect. We believe motorcycle volumes would grow at 7 to 9% year on year in FY18. India Ratings assessment is based on the assumption of normal monsoon in FY18. The two-wheeler segment was most impacted by demonetization drive of the government and displayed a significant volume decline in November and December 2016. With increased currency in circulation, the volumes have recovered in Jan 2017 and we expect significant recovery in Q4 FY17 and Q1 FY18.
And now, from autos to the resources powering them. Vivek is up next to explain why he sees a stable outlook for oil and gas companies, but why the steel sector is not yet out of the woods.
India Ratings and Research has maintained a stable outlook on both public and private sector oil and gas companies for FY18. INDRA expects public sector companies to sustain strong linkages with the Government of India or maintain business stability in case of standalone ratings. The upstream companies are likely to benefit from the increase in domestic gas prices, the higher crude prices, and the almost nil subsidy burden expected to be borne by them during FY18. The downstream companies, on the other hand, would see a moderation in their GRMs during FY18. Their continued capex is likely to result in leverage inching up moderately. However, their credit profiles would still remain comfortable. India Ratings and Research has maintained a negative outlook on the steel sector for FY18, as the agency believes that the sector will continue to face both operational and financial challenges during the year. Profitability and cash flow are unlikely to improve significantly in FY18 due to the continued muted demand, limited pricing power due to global overcapacity, and significant increase in cost of inputs. The agency has also maintained a negative outlook on its rated steel entities for FY18 in view of their high indebtedness. Some of the rated steel producers require significant deleveraging and cash flow generation to maintain their ratings at the current level.
So that was the view on oil and gas. Now Salil joins us for the agency's perspective on what's driving the outlook for the power and telecom sectors of India and the related issues at play.
INDRA has revised the telecommunication services sector outlook for financial year 18 to negative from stable to negative. The negative outlook reflects the agency's expectation of a longer and deeper than expected deterioration in the credit profile of telecom companies following the extended free services by Reliance Jio. The existing telecom companies would lose market share to Reliance Jio and suffer profitability, while the debt burden will increase due to spectrum and network related capex. Decline in data tariffs will pull down the average revenue per user despite higher volumes, while the voice revenues remain at risk due to Reliance Jio's declared voice pricing strategy. Free cash flows will be negative due to double whammy of weaker margins and capex. Data will be revenue driver for the telecom companies. As voice revenues have matured, we are expecting increase in per capita data usage by about 35 to 40% in financial year 18 to 1250 MB from 600 MB in financial year 16. RGO's data-centric business strategy, proliferation of cheaper smartphones and accelerated adoption of 4G are the catalyst for higher data usage. Data is expected to form 30% share of the telecom revenues in financial year 18, while data revenues would grow by 15 to 20%. Higher data volumes would not lead to commensurate increase in revenues. In the immediate term, a data realization would decline by 20 to 30%. Data price decline is driven by highly price elastic data demand as well as operating leverage. Having said that, there is structural shift in pricing plans which move towards bundle tariff with limited charges for voice.
Turning our attention to the core sector, infrastructure. While the sector is the backbone of the economy, hurdles here continue to remain. Shiva now joins in to break down the reasons for the negative outlook on the sector.
We maintain a negative outlook on the overall infrastructure sector. Negative sentiments in large subsectors, power and road, weighs on the favorably placed airports and the stable sectors like availability-based projects and solar. However, the emerging innovative financing models like InvITs, partial credit enhancement, and pooling of assets bode well for the sector. Our belief is that the new financing model like InvIT and subordinated debt with no rights to call an event of default or debt payment acceleration has the ability to bring a paradigm shift in the credit profile of the assets. Toll roads are seldom on an even keel for long. We forecast a revenue growth of 6 to 8% across INDRA portfolio in FY18. However, projects in ramp-up stage need a minimum of 9 to 10% growth to meet the debt obligation. Nevertheless, modest inflation may provide a salutary effect on coverages. 1 month of toll suspension in November 2016 permanently impaired several sub-investment grade projects because they dipped into debt service reserve account and other available liquidity backup to service debt. Therefore, notwithstanding timely compensation by the concession grantor, replenishment of reserve is unlikely in FY18. While some sub-investment grade projects deferred life cycle cost due to low wear and tear in last year, many would undertake in FY18. In the absence of reserve buildup due to weak traffic growth in the past, projects are likely to contract additional debt, leading to further stress on the fledgling finances.
That's it for now. There are many other views from the Outlook series available for you to watch at the India Ratings and Research video gallery. Thank you for tuning in.